The Fed had just cut interest rates by 50 basis points. This will have a big impact on everything around you, from the stock market to savings accounts to loans. In this video, I'll be showing you, based on historical data, what happens whenever there's a rate cut and what you should do to benefit from this. But before I start, do join my 10,000 members Telegram chat group to discuss or ask any questions that you might have. As mentioned earlier, the Fed had just cut interest rates by 50 basis points, effectively bringing the rates from the 5.5% range down to 5% range. And looking at the latest dot plot, the Fed is expected to cut rates by another 50 basis points by this year, meaning we should see rates come down to around 4.25 to 4.5% range by Christmas time. Ho ho ho. This was a rather surprising move, given that many people initially expected the Fed to only cut rates by 25 basis points. But I guess Jerome Powell doesn't mess around when it comes to these things. Jokes aside, the real reason the Fed is now finally starting to cut rates is because they are now confident that the inflation is under control. Inflation is now swiftly trending downwards. But perhaps the bigger reason is because the Fed is now getting worried that the job market is weakening. That's because while the unemployment rate still remains low, it is now starting to rise at a faster pace. Meanwhile, non-farm payrolls have been trending downwards, and if left unchecked, once the demand for workers has cooled, it becomes harder to stop the rise in unemployment rates. And because of this, the Fed knows that they need to quickly cut rates before things get worse. Which brings us to the juicy stuff. What does this mean for the stock market? Will it go to the moon? Or will it go to the moon? Charles Schwab shows that over the past 100 years, over 14 rate cuts, 12 of them saw the S&P 500 giving positive returns 12 months after the first rate cut. Basically, stonks. But the question is, what makes the other two rate cycles so special? Shouldn't the market also go up whenever there's a rate cut? The answer is recession. Historically, if there is no recession after a rate cut, the market will tend to go up, especially right now, given that there's over $6 trillion sitting in money market funds just waiting to be deployed. On the other hand, if there's a recession, the markets will tend to go down over the short term. This has happened in the 1960s, 1970s, and the 2000s. So the question is, will there be a recession coming soon? According to the New York Fed probability of recession model, there's now over 60% chance that we might see a recession happening in the next 12 months. But personally, I wouldn't worry too much yet, because even though it looks like a recession might happen, there's still a chance that the US might be able to avoid it. For example, even though the job market looks weak, one analyst mentioned that there are still new people entering the workforce last month, and the higher unemployment rate was just caused by the bad weather. To add on, consumer spending still remains strong, GDP growth rate is still resilient, and corporates' next year's earnings is expected to continue going up. But even if a recession is about to come, the Fed is still able to cut rates in order to take some pressure off the economy. So for now, we are still good. As we are nearing the US election date, there will be a lot of volatility going ahead. That's why it's important to use one of the lowest cost brokers in Singapore to trade. And for that, you can check out Webull. For the US market, during regular and extended hours, they are just charging a low fee of 0.025% with a minimum of 50 cents. And for overnight hours, they are charging 0.03% of the total trade amount with a minimum of 89 cents. For the SGS market, commission is 0.025% of the total trade amount with a minimum of 80 cents. And the platform fees is 0.025% of the total trade amount with a minimum of SGD 80 cents. New users will get to enjoy commission-free trades for US stock trading for 1 month and commission-free trades for Singapore stock trading for 3 years. Right now, both new and existing users will also get to enjoy US options free commissions if you trade a minimum of 100 options contracts this month. For new users who use my exclusive link to sign up to Webull, if you fund your account, trade, and fulfill the respective criteria, you'll be eligible to get up to $400 cash vouchers and up to 7% per annum yield for the USD Money Bull for up to 90 days. When you fund a cap of $100,000, potentially earning a yield of $1,750. Or if you are an existing user who has not transferred any shares into Webull before, you can also take part in the Transfer In promo, where you can get up to $1,500 trading vouchers when you fulfill the requirements. So if you are interested, do sign up to Webull using my link down below. And let's get back to the video. But if the recession did not come, which sectors will do well in a falling interest rates environment? According to Fidelity, the sectors that have historically done well after rate cuts are consumer discretionary, technology, real estate, and financials. These are companies that are more sensitive to interest rates. For example, companies like Louis Vuitton and Toyota would benefit from lower interest rates because this means it's now cheaper for consumers to borrow and buy their stuff. Likewise, REITs would also do well too, given that they can now save more on lower interest rates. In fact, Singapore REITs have been sibei strong recently, as investors were expecting a rate cut prior to this. And what about Magnificent 7 stocks? Unfortunately, if you are investing heavily in the Magnificent 7 stocks such as Apple, Microsoft, Amazon, and Tesla, you may want to be prepared because this rate cut could drive investors to search for better value stocks rather than just stick to the Magnificent 7 stocks which may be highly priced. So if you are a stock picker who's willing to do all the research, these are the areas that you can look at. Otherwise, if you are a noob like me, it's best to just stick to broad-based market index funds like the S&P 500 Index Fund or the All World Index Fund and just ride out the wave. And here's a small tip. Rather than going for triple Q, which limits itself to just the Nasdaq index and just so happens to be tech heavy, you could instead check out SCHG as it covers a wider range of markets and has a much better methodology of selecting growth stocks, such as looking at the projected price to earnings ratio, projected earnings growth, price to book value, trailing revenue growth, and trailing earnings growth. But of course, this is not to say that the market will confirm plus chop go up, right? Because later the market crashes, there will always be that one guy who's like,
"You see lah, Kelvin, you keep telling people to keep buying. Now market crash down. Everyone lose money now lor."
Don't be that guy, yeah? Because as an investor, you always want to have a long-term view, and any dips in the short term are just opportunities for you to buy even more. So in the short term, there can be a million unforeseen circumstances that can cause the market to go down. For example, if Trump wins this election and starts his spending plans, it could cause inflation to go up again, and the Fed be like, ah shit, here we go again. Or another war could happen in the Middle East and cause oil prices to go up. Or maybe the Russia-Ukraine war could escalate and drag in other countries. There are many things that can go wrong and cause the market to drop. In fact, even if nothing goes wrong, investors who front-run interest rates news like this can just take profit and cause a mini dip, like what just happened. But as I've said time and time again, market up, you buy. Market down, you cry a bit, then you buy more. And you'll be fine over the long term. Now, besides the stock market, everything that has to do with interest rates will also trend downwards, starting with savings accounts. So right now, high-yield savings accounts like OCBC 360 and UOB One are still giving around 3 to 4% average return. And with interest rates going down, I would expect to see banks start lowering rates within the next few weeks. As to how low they can go, if we look at the rates that they were offering back in 2019, they were only around 1 to 2% per annum, which is meh. That's why some banks like DBS, UOB, and OCBC have started to do promotions to attract us to switch over to using them. So do check them out and quickly redeem them while they are still available, yeah? Likewise, all the T-bills, fixed deposits, and high-yield cash management accounts like StashAway Simple Plus and Safe Cash Plus Guaranteed and Chocolate Finance will also be lowering their rates soon. So if you have any money that you might need within the next 1 to 5 years, you may want to start moving them to places like Singapore Savings Bonds to lock in a decent yield for the next 10 years. Next, if you are a homeowner who's taking a bank loan, good news, because your interest rate will be coming down too. So far, the 3-month SORA rates have been slowly trending down from 3.76% to 3.57% this month. But here's a question. If you currently have a loan now, is it better to refinance now or wait for even lower rates before you refinance? Personally, I would refinance now because if you are currently on a floating rates loan, you would be paying about 4% in interest rates and be like, huh? Meanwhile, fixed rate loans are now just charging about 2.8% interest rates. So it's probably better to refinance first, lock in a lower rate for either 1 to 2 years, then further reprice down to even lower rates once the lock-in period ends. Pro tip, a good place to look for home loan is at the Property Guru Finance website, where you can compare between different loans across different banks, yeah? Anyway, that's all for this video. Hopefully you found this useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.